Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The market's playbook is finally here. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk's eye. Options and plays in a live display. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk's eye. Options and plays in a live display. Every move counts in the game they play. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, step by step they break it down. No confusion, no spinning around. With every trade they set the tone, making big calls from their trading throne. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, this is where the big plays are made. Oh. Opening playbook, we're ready to roll. Daily moves that will fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh.
Good morning, everyone. Welcome to the Monday, September 22nd opening playbook. I hope everybody had a great weekend and you were able to make our special session with Silas Peters last night. And of course, Graham Lindman was there as well. How you guys doing this morning?
Oh, doing pretty good. I actually planned on being there last night as well. So sorry for my absence. Wasn't feeling the best. And I know Graham said he's not feeling great this morning. So
I'm a little under the weather too, Nate. I was feeling it last night. I don't know if you guys could hear it in my voice, but for a minute there, I'm like, oh no, my voice is going to go out halfway through the class. And luckily,
No, you held up. You did pretty good.
Yeah, my daughter and I are both feeling under the weather. So far, my wife has been in the clear, but we'll see if she can hang on much longer.
Yeah, well, I hope she does. Yeah, it was pretty cool to get, even though I wasn't able to be there last night, just to kind of see the final details come through. We'll talk about that a little bit more later as well, but hope you guys enjoyed getting to know Silas a little bit more and really, kind of experience the intuitive nature of what he does. I mentioned on Friday, I've heard people talk about insider buying a lot. Obviously, a pretty common, conceptual idea. But there's lots of nuance there. Are they just buying because they got a bonus check? Are they selling just because they want to buy a boat? Or like all these different things. And so to have someone who really put the work in to actually bake that down into actionable ideas and see it come to life, super cool. I know, Graham, our very first call with Silas going back a while now, he popped it up and we were both like, oh, wow, this is a different animal than just like your person posting some spreadsheets about what insiders are buying.
Yeah, it definitely is. And the cool thing too, like people are asking, like, hey, what's the difference between this and Lance's scanner or some other things as well? And the cool thing, like Lance's scanner is great. We use it all the time in here. Lance does quite well with it. But those are option buys that could be coming from anybody in the world. They could be hedges, they could be speculators. We don't know who's buying what. Now, again, I'm not like Lance does a great job with the scanner. The cool thing with what Silas does is we know who's buying these shares. It's
Yeah.
specifically C-suite individuals, board of directors, VPs. We even like one of the examples, Nate, was the head of HR
Mm.
in a big buy. That's where it's really, really cool. When people on the inside, people that care about the company, know about the company are buying, that's pretty compelling.
Yeah, no, for sure. Cool. Well, I am anything by the way, Graham, that housekeeping wise, sometimes we kind of skip right into stuff and I don't always give us a chance. So
Housekeeping wise, two things, and it has nothing to do with housekeeping. Number one, I sure hope you guys are making money on Tesla by now.
oh, dude, what an animal. What an
I mean,
animal.
Nate, you were probably the first to bang the door on it January, February-ish. I jumped on the train. Of course, I've been trading the cycles a little bit. Just keeps going. Nate, it's amazing. Again, we drew those trend lines at the beginning of the year. I'm just looking at my screen right here. They're about to hit the upper end of that range.
Yeah. I'm actually going to share. Yeah, I'm going to share a chart there in a minute, but exactly right. I mean, it's one thing to, zoom out and say, hey, in a year from now, Tesla could be here, whatever. Another thing to actually take the trade and have the patience to see it happen. So
yeah, we did we did one with it was a seasonal pick from a couple weeks ago. It's up 291%, 295% now.
oh wow,
That's
yeah,
awesome. The other one I was going to mention for my housekeeping that has nothing to do with housekeeping is Apple. And Nate, we were about 50 cents on Friday away from triggering another perfect Apple entry. Didn't quite get there. But that stock's up another 2.5% today. And I hope you guys are making money on Apple too. I know that's one that we mentioned back when it was $200, saying, hey, we don't know. This one's been kind of a dog, nothing new, nothing exciting. We don't know when it's going to rebound, but this is probably the one stock that we are most confident to say that it will see all-time highs again, which is about 30% upside from where it was at. And it's almost back there. It's at 251 this morning. So I'm not reaping as much rewards on Apple today as I am from Tesla, but just very interesting to see. And I don't even know, Nate, like my thinking was we'd see some sort of news catalyst, some sort of AI release. I haven't seen anything cool. I mean, they got a new iPhone, but
yeah,
they get one of those every year.
yeah. Nothing. I don't think anything too out of the ordinary. I mean, they did a couple smaller acquisitions, but
Mhm.
they didn't even really respond during when they did them. It was,
But
if this is a response to that, it's a very delayed response to that. But I think, ultimately, it's one of those things where a company that has an incredibly good operation and is going to pump out really good earnings and good cash flow over and over and over again. I mean, eventually it's going to catch up. The market's going to price that back in, even when it gets, when it falls out of love with it for a short period of time. It can only ignore it for so long. So I think we're seeing that.
yeah, and I have to wonder if it's just to the point now where everybody's saying, Nvidia's perfectly priced, Meta's up nicely, Microsoft's up nicely. Maybe I'll just rotate into Apple, knowing that it's going to catch like the same theory we had, and it's just now playing out.
Yeah. I mean, definitely could be exactly that case. By the way, Tesla and Apple, two stocks that I'm gonna mention today. So you're on
Perfect.
the
Should I
ball.
keep going?
Yeah, maybe.
Bitcoin's down over the weekend, which again we said September's typically bearish for Bitcoin.
Yeah,
It was
I
down
traded
like
it to the long side on Friday. I'm feeling great about that.
well, at least you didn't trade it to the downside at the beginning of September because it's still up nicely. A couple pointers there. Number one, I would not be shocked if we get a little bit further sell off. You guys know I would think the same thing market wide right now. Of course, the S&P is fighting back to break even now on the day. Oh, I forgot to ask you, how did the weekend options do?
Well, of course, weekend options stayed undefeated. It's almost like just a checkbox at this point.
You gotta be careful what you say there, but
Yeah. No, I
yeah.
don't mean in the future. I mean
Mhm.
once we're talking about in the past, Graham, of
Right.
course.
Of course.
By the way, yeah, the market is bouncing back. I'll share a couple things. By the way, here we're just easing in on a Monday morning here.
Uh,
But the first thing I posted, Graham, this morning was the market's probably going to bounce back to break even within the first hour of the day, because it's just
insane.
When you get these like just small pullbacks, when it's just like nothing happens and this market just wants to march higher, and boom, we just hit zeros on the SPY. So give me a checkbox on that as well, because we are right back to break even. Unbelievable in this market.
Yeah, it is. It is really quite unbelievable. My last pointer here. And it's not something that you may want to do today, although it wouldn't be bad. I bought a bunch of MicroStrategy stock, MSTR. You guys probably remember that one from last year. That one just crazy, Michael Saylor stock. The reason I'm doing it isn't because it's one. Well, I was going to say it's not one I want to buy and hold forever, but maybe it is one. I don't know. I don't have that big of an opinion on it for that far out, because I kind of like very a polar opposite reactions to the stock. But in the near term, I do think October, November, December is going to be great for Bitcoin. And I think my assumption is that MicroStrategy will outperform Bitcoin with the excitement around there, the melt ups, the rate cuts, all of that making it much better for Michael Saylor and the team. So that was my third little housekeeping.
Well, Graham, I have 5 stocks I'm going to show, and MicroStrategy is also one of them.
Wow, Nate, we agreed on almost everything last week.
Except for I'm going to say short on MicroStrategy. So other than that,
oh really? So we did not agree. Perfect.
So you have 5 stocks in the entire universe. You pick 3 that I already have charts on that I'm going to show. That one though, I actually like short-term short, long-term long. So I don't know. Maybe we're exact opposite on that, because you like.
I would say over the next 10 days, I don't love it long, but I would say over the next.
Okay, well, it's a this
months.
week. It's a this week short, and then it should hopefully hit a support level, and then I think it's back to the long side, because we've been loving these catch-up trades. I mean, we haven't hit everyone, but we've hit a lot of really, really nice catch-up trades in opening and closing Playbook. I mean, ANET was unbelievable.
Oh my goodness.
Tesla, Apple's now finally catching up. We had what were the other ones? The other industries we had some big catch-up trades. I mean, those have been small caps obviously got the catch up. So anyway, I
want to read you something from Friday that I didn't catch live. I caught it after I was going through stuff later. Mike G posted yesterday the overnight options had a bullish sentiment and the 60-minute trade had a bearish sentiment, and both were winners all in the same trading day. What sort of sorcery are you spooling up there?
yeah, sometimes those happen. I have a lesson to kind of talk about that, but we sometimes that happens. That's the power of the take profits in large part. Don, I mean, in the last half hour of the day or last hour of the day, the market will move pretty quick. Now, I actually missed weekend options a little bit late to get in it, but it did come back about 10 or 12 minutes later and filled for the price, because what I'll do is we'll package it up. I won't get in right away. I'll wait until we package it up. So I got in about maybe 12 minutes after. That's just a guess. I'm not actually looking at my fill, but maybe 12 minutes after we sent the alert. It just came back a little bit. So anyway, let's go ahead and jump in. Happy Monday, everyone. Hope you had a great weekend. Hope your football teams won. Graham's football team has John Elway reincarnate leading the way for Indianapolis somehow. Who would have seen that coming? But we are now back into another beautiful week of trading, and I'm looking forward to it. We had a phenomenal week last week. Just so many great picks. I mean, Graham, I don't know if you ended up actually sharing that screenshot in Telegram or whatever with some of those triple-digit winners, but really a great week, a fun week. But I mentioned I actually burned up some money on some hedges, just kind of getting too like, oh, hey, what if we sold off the news and that sort of thing. So I'm actually going to talk about that a little bit, because I don't really believe in hedges traditionally, and I always will tell you guys be careful with them, and I'll talk a little bit about why today. But first, let's just talk about the market. I think a shift that's happening right now, a couple stocks for the week ahead. Graham already mentioned several of them, and then a quick lesson for the week, which does have to do with hedges, and I'll give you an alternate idea. I didn't add a bullet here, but obviously we are going to talk about the insider opportunity, because I think that's a no-brainer for you guys to check out. I would even say, as the market does get it kind of in this melt-up territory, and you have to start, both being careful about where the market is and also try to find opportunities that are, more robust and not just, going with the flow and then could take a crater at any moment like we've seen. ones that have that level of confidence, that have insider, cluster buys and an agreement among boards. Really interesting to take a look at those. Anyway, here is our market. This is the S&P 500, guys. If you remember here, we had this breakout candle through the 600 level and above that high, and I said, I think we're on. I think bullishness is back. Let's go. Let's run. I have been obnoxiously bullish ever since then, and we have been ripping. Now, honestly, as bullish as I've been and as great of a couple months as I've had, which I hope you guys have had a phenomenal couple of months as well. Overnight options has been on a tear. Weekend options is undefeated. Two-way options has been great. Profit pairs has been great. Like, I feel very, very fortunate and blessed to be on the right side of this market. I honestly still feel like I haven't taken full advantage because it's just so much potential, so much running here that there's been more potential since these April lows than probably COVID in terms of incredible runs to the upside. But the question, of course, on everyone's mind is, okay, now what? We're so high. We are overextended by any technical definition of the word. We have 1, 2, 3, 4, 5, 6, 7 weeks of green candles in a row. What happens next? And by the way, something I stole from Chris Pulver here. He posted, if you look at the daily chart of SPX, which is the SPY, just the options for the SPY, and you look at the 50-day EMA, the average time when the SPX or the SPY crosses above the 50-day, the average time it stays above before crossing back is 23 bars. Our current time is 97 bars. So we are 4 times above the EMA, time-wise than we would typically expect. Now, the top 3 all-time are 105, 112, and 128. That's daily candles above the 50 EMA, and we are 97 above. Now, keep in mind, these 105, 112, that would also include when it starts, coming back down to the 50, right, before it crosses. So it's probably more like 97 before it started folding back down, right, because you're counting the bars before. Now, this is concerning that we are overextended, but if you guys know me, you know that I am not traditionally worried about trying to get ahead of those quote unquote overextended markets. I'm kind of on record saying I don't believe in overextended markets. And that's because what most people underestimate is actually how far the market can stretch. And so I do think we are still in a melt up environment. Now, the last 8 days of September, if we wanted to get a flush before a continued melt up, this would be the time to do it. The market is overextended. Seasonally, we're in a time where the market is typically very, very weak. And there's several other factors that I think could lead us to that little liquidity flush before we continue higher. But I just don't think it's wise to bank on that. In fact, I got a little too cute last week with the Fed interest rate and did more hedges than I even kind of realized I put on because, we had 10 sessions, right? Opening playbook, closing playbook every day. I said, well, here's a hedge idea, and here's a hedge idea. And if we sell the news on IWM, here's a hedge idea. And then I looked at my account, and by the end of the week, I'd lit $2,500 on fire just throwing hedges out, which is, ironically something I don't even believe in. I just kind of was saying, hey, this is some way that you could set up these trades with a positive risk to reward. And so I'm actually going to show you today, I'm going to do a corrective analysis and show you why I don't believe in hedges, which ironically, like I said, is a lesson I've already given in the past. And yet we'll talk about today why I don't think that's normally a great idea. But anyway, that is the situation that most people get into. They feel like the market is overextended. They feel like it can't go up anymore. And oftentimes they have correct fundamental analysis. I always use the Michael Burry example, right? Michael Burry had very accurate fundamental analysis in 2006 going into 2007 that the market could not sustain more bullishness, right? It was fundamentally broken. People couldn't pay their mortgages. All of the stacks of just junk assets that were holding the market up were fundamentally broken, and it had to crash. And he was right. However, the market continued ripping higher for another 1.5 to 2 years, even after it was fundamentally broken. And so you just have to be very, very careful when it feels overextended, it looks overextended, and frankly, it might even be fundamentally broken, that doesn't mean that it's going to come down on your timeline. Okay, so just a word to the wise there. All of these things are true, but that doesn't mean the market is going to come down on your timeline. Now, what is the shift that's driving this? Let me know, guys, in the chat, by the way, if you heard maybe 2 months ago, 3 months ago, this would have been like after the April recovery, getting into June, July. There was a lot of people saying, hey, the market's melted up or the market's rebounding, but it's not fundamentally bullish. Or I guess maybe not fundamentally bullish. They would say something like, it's not risk on, or it's not intensity driven. And what they meant, let me know if you've heard anyone talk about this. What they meant is they would say things like, it's not really being driven by the tech. It's not really being driven by Mag 7. The RSP, which is the equal weighted S&P, is actually gaining ground. We still have 70% of stocks below the 200 EMA. We're still not seeing strength across the board on the risk on assets. We're seeing gold be way too high for a risk on environment. So they weren't saying like, hey, the market is, not actually moving up. They were saying things like the underground, what's actually driving the market is not what you should see in a true bullish market. And one of the examples that we often pointed at, including in opening and closing playbook, we'd say, listen, the SPY is actually outperforming the QQQ, which is certainly not what you would expect in a strong bullish market, right? Anyone else hear a lot of that analysis? Now, there are two ways to kind of look at that. One, you could say, okay, what this is showing us is that the market is not actually healthy and bullish. It's not actually in a position to rip higher. It's kind of a mirage, and we should see it flip back to the downside. But the other way that you could look at it, and this is the way that Graham and I chose to look at it, is that it's actually a catch-up opportunity where when the QQQ and the other technology and the Mag 7 catch up, we're going to see even more bullishness. And I think that we were correct in that analysis. We saw the technology side of things really start pacing above. You can see it right here last week. Really good week in the market, but for the most part, everything else was kind of blended into 0.5, 0.8%. Communications did pretty well, and then technology certainly drove us much higher. And so we're starting to see this shift where tech becomes the driving factor that we would expect. So the interesting thing about that, if you go back to our last chart here, if we go back and you say, okay, the market's really overextended, and I would say technically, yes, that's true. What's interesting is that technology is really starting to drive only in the last couple of months, which usually means there's actually more upside ahead. So here's one thing to think about. In technology, we're not just seeing Intel, which had an unbelievable 22% run drive. We're not just seeing CrowdStrike. We're not just seeing AMET. We're not just seeing some of these other, KLA and Cadence and all of those that had 8 and 9%. We're not just seeing ANET that had 7%. We're not just seeing Intuit and Palantir. We're not just seeing Fortinet. We're not just seeing Oracle. We're not just seeing Dell. We're also seeing IBM and Apple and Adobe and IT and Micron. 54 of 68 technology holdings were positive last week. Okay. So it's not just like, Intel had the deal and jumped 30%. We're seeing a mass amount of positive performance across the technology sector that is showing, in my opinion, a real shift of happening. So what a lot of people are pointing to, and this is hopefully what my little bit of a ramble here is driving to, is that a lot of people are seeing the gap happen. By the way, the exact gap that Graham and I predicted at the beginning of the month, where small caps have driven, they're leading the pack. The Qs and the SPYs are kind of lagging behind small caps. And then the RSP, which is the equal weighted S&P 500, is lagging the most behind. And so what this really shows you is a picture where small caps are the best position. The big companies are kind of lagging behind. And then you have, your regular companies falling below and underperforming. And so a lot of people are showing this and they're saying, yeah, look, this is what the gap looks like. But I think what they're missing is if you take the exact time frame, you take the exact assets, and you just add in the Mag 7, then you get the real gap. Okay, so this is what I would consider the real gap. And if you guys were on our Sunday night session 3 weeks ago, I guess that was, this is what we predicted. I'm specifically on record saying I expect the mags to do really well and the small caps to do really well and gold to do really well. And I think the mushy middle is kind of what you want to avoid. I think the stuff that's in between doesn't perform as well. So while a lot of people are looking at this chart, the one before, and saying, look, small caps are outperforming, the big dogs are behind because the QQQ, I think they're missing actually the top end is still driving a lot of the performance here. And the IWM is actually doing great, but underperforming those really top end performers. So that basket of trades that I gave you folks, IWM, mags, gold, I still think is a really good opportunity, whether we get the melt up or a slowing down. Okay. All right. Let's talk about stock for the week. All right. Number one, I mentioned, Graham said MSTR to the upside. I said, well, I actually think we got a short-term MSTR to the downside. So for this week, I actually, we got a breakdown. We got a little pullback to the 360 level. I think MSTR, especially Bitcoin, does stay red. I think we can see it flush pretty hard right then. And then I actually do like the ability to buy MSTR somewhere back into the $300 range if it gets there. So MSTR, I think, is an interesting short. Of course, it would have been better if we shorted it right here as it rebounded. This 360 level has been a really strong level for MSTR. If we would have shorted it right around 360, I think it'd be a good opportunity. You could trade this a couple different ways. One easy way to trade this would be a bearish debit spread, is what we traditionally do. So, like a 325 or down, even if you wanted to go more aggressive, 320, 310, you could get several 100% ROI over the next couple of weeks if MSTR flushes to the downside anywhere close to that $300 level. So keep an eye on MSTR. We'll see what happens. Obviously, if Bitcoin rallies and gains some strength, then I don't think we will see MSTR follow suit, right? Like, it is going to be somewhat Bitcoin dependent, but that is MSTR. Again, target level there would be like 320 for just like the, kind of the slow weakening, and then 300 for like a really aggressive pop. Next, we have Apple. Apple, we called all the way down at 200. If you guys remember, it was a unpopular pick, I would say. If you guys watch my market beat interview, I don't think people were loving my Apple pick, but it has been an absolute monster since 200, up over 25% on the underlying stock. And we have this little gap here. Everyone see this little gap between these kind of key levels on Apple. It's only about a $10 gap. But I think if we're able to power through, you can see how much of a squeeze kind of bullish move we have right now. I think we pretty much will run right into 260 without much hesitation. So again, if you're trading call options, there's probably not a whole lot of money to be made on a move from 254 to 260. But if you want to trade a debit spread, just even kind of in the middle there, like 255, you can actually do really well, even if all Apple does over the next 2 weeks is kind of run and fill in this small gap here. So that's Apple. Again, maybe a 2-week trade or a 3-week trade just to give it some time. But I think if we move through here, we will run into that 260 level. And again, debit spread, you're going to be able to do fairly well. Then we've got our friend Tesla here. Got a breakout. If you guys have been trading Tesla, I've been trading it all the way since the 240s. But if you're trading it even just since the most recent breakout, you're already well ahead. Now, Tesla's probably too overextended to justify a buy. I mean, I say that, and at the same time, this thing, if any stock can just rip without holding back, it would be Tesla. But if it came back and filled the gap here at 400, I think it's probably a no-brainer buy here on Tesla, to be honest with you. Not because it's guaranteed to go up. Tesla is a very volatile, very unpredictable stock. And if it rips down to 400, it could rip down to 300 for all we know. You know what I mean? Like, that's the way that Tesla trades. But the reason I say it's probably a no-brainer is just because that risk reward that we talk about. Okay. So, if you get it down to 400 and you want to trade a 480 debit spread for, let's say, March of 2026, right? Give it 5 months, you're going to make like 600% ROI on that trade if it happens. So it's a no-brainer from a risk reward perspective, not a no-brainer because the direction is guaranteed. So I like Tesla. Whether you justify trading it already as it's kind of, technically overextended by any measure, obviously you have to make a decision for your own. Thankfully, I'm already in it, so I don't have to make that decision on my side. But I think it's a powerful stock that is pretty much dead set on making its way back to all-time highs.
Nate, is that a good case for like a reverse iron condor, where you kind of have the hedge built in to go the other direction, even though we don't love hedges?
Yeah, I'll talk about that in a minute. But yes, Tesla, easy two-way trade right now. Now with Tesla, because it is so volatile, that's priced in a little bit. You're not going to get like 100% ROI by just trading in a couple dollars on either side. So you have to adjust with the stock. But we'll talk about that in a minute. And Dave, yeah, maybe that's one I'll actually give a trade on the two-way side, because I am going to give a different two-way trade. But Tesla is one that almost always fits the bill once it gets rolling. Right? You don't want to trade two-way trades down here where it's grinding, but once it gets ripping, like this is actually a great example, right? If you took a two-way trade in the 320 range over here, once it got ripping, well, you'd hit the two-way to the upside and you'd hit the two-way to the downside, because that's how much Tesla likes to move. So we can cover that here in just a minute. Disney's an interesting one, guys. Not a trade that or a stock that I can say I've traded a whole lot or that I love trading, but it's an interesting stock. We're right at this support level, so we're kind of right at a decision area on Disney right now, and there's quite a bit of room, because if Disney pops up back into the 116 range, that's 3 to 4% move on the underlying. If it breaks down and comes in this 105 range, that's like a 5 to 6% move on the underlying. So Disney's at a really nice decision point. I would keep an eye on it this week. I think if we get a break to the downside or a kind of solidified, stopping the bleeding to the downside right on top of this 112 level, I would be happy to trade this one in either direction. You can see historically here, Disney, although it does get in these ugly channels, if you get some momentum, here's the last breakout sell move we got. What was that? About a 20% move. And then you can actually see before, I'm not sure if this is clear, but over here on the left side was our last breakout as it kind of crossed 96 and then eventually crossed 100 and got up into the 118 range. So that was also about a 20% move. The one behind that ripped, and it was great. It was about a 7% move here. But some of these are really significant. So Disney does have the potential to move. I don't think, Mike asked, does the Jimmy Kimmel thing impact? I don't think it will impact a whole lot. The reason being because if you look at all the analysis of his show, it wasn't bringing a lot of revenue in anyway. And so I don't think that's going to be priced in a whole lot. But I guess, I'm happy to be proven wrong here. Maybe just the turmoil there. No, Dan, I that trade is open. I have a 90-cent target on it. Let me see what I'm at right now. It is showing that I am at 82 cents right now. I have a 90-cent target on it, Dan. Close it if you want. We're profitable. Qs, like I said, profitable on the day. Unbelievable how resilient this market is. But I did not hit my target yet on that QQQ trade. Last one I want to show you guys, IBM, and we can do a live trade on this one. This is just a kind of classic fill the gap trade as it broke above this key level on IBM. So let's go ahead. I'll set up a trade here for you on IBM because I think this one is the clearest of the trades, right? I like it to the upside, and it also has a very clear target level there, as you saw into that gap. So let me pull up my chart. That gap is right about 280. Sorry, I just got to switch my screen so I can share my actual brokerage account with you. All right, let's just quickly look at IBM again. Here it is on the weekly chart. Wow, what a beautiful weekly chart, by the way. Broke above these 265 wicks there, which was nice to see. But if you go to the daily chart, there you can see the gap. It's right about 281. We can trade this to the 280. We can be really aggressive with this trade. We can be super aggressive on it. But I'm probably leaning toward a little more patience on this one. So if you go to IBM, the super aggressive way would be to trade like October 3rd. That would give it 11 days and basically just say, hey, in 11 days, it's going to move up $10 over 3%. But if all you do is just give it some time here, like 25 days on the October monthlies, you can take the same trade and just shave a little bit of ROI, but give it over twice as much time. So the trade here would be all the way up to the 277, 50, 280. You can see still going to be well over 100% ROI on this one. And what you're doing is you're trading to fill the gap. Now, I will use a target here because if it hits the gap and reverses, I would like to get out of the trade. And so I will use a gap. I will use a target. And if it fills the gap and I don't hit my target, I'll close it anyway. Okay. Does that make sense? Just give me a quick yes in the chat, because before I give these trades, I always like to make sure that we're on the same page. I don't want to give you trades that then you feel like you don't have to, or you don't know how to manage. So the idea here is we're trading to fill the gap. And if we do fill the gap, we want to be out of the trade, right? Because then our trade has done what we wanted it to do. And so if it doesn't hit the target, which it should, but if it doesn't hit the target, then we close it out because the trade has now done what we wanted to do. So this is a different scenario, right? Sometimes we're trading an open-ended move. Here, we're trading a very, very specific move. And so again, we will use a target, but if it doesn't hit the target and we do fill the gap, we will get out anyway. Does that make sense, Dave? I want to make sure that I'm.
Yeah, it does. Although I'm not sure everybody knows what fill the gap means, even though you've talked about it a little bit. But if you want to define that a little more specifically, like
easy way to do this: if it hits 280, get out of the trade. If the underlying hits $280, hopefully your target will be hit. But if it doesn't hit, we want to get out of the trade. So I just want to be clear on that, because I know in opening and closing playbook, we throw out a lot of trades, we get a lot of ideas, and managing them is sometimes the hardest part, right? Not everyone knows, okay, how are you managing this? Is it a target? And when we're trading a very specific concept, which in this case is filling the gap, I do want to make sure that everyone is on the same page. Okay, let me post this in the chat. It is going to be buy to open the October 17, 277.50 IBM call, not OBM, IBM call. It is going to sell to open the October 17, 280 IBM. By the way, we're trading the monthly, so you get a little extra volume on that and stuff like that. So a couple other advantages. Debit here is going to be about 83 cents. Okay. So let me first post that, and then we'll flip over to our calculator, and we'll get that in. So let me go ahead and put on a couple contracts there. We'll see if that, filled right away. I always love it when we're not having to sit here and crawl our order and chase it around. Okay, now let me move over to this, just so we can do our target. Boom. All right. Sorry, guys. It takes me, I'm still not the fastest at switching screens on the platform. So bear with me as when we're kind of jumping around here. What we're going to do here, this is our opening playbook membership area. You don't need this membership area to do what I'm about to do, because I'm going to give you the target right here. If you do want to get it, it's $1. So you can do that, obviously. But we're going to go to the debit spread assistant. That opens up this window. And this lets us do debit spreads or credit spreads, calls or puts. Obviously, in this case, we have 2 calls on. So all I do here is I type in the calls that I put in, 277.5 and then 280. Our entry price here was 0.83. So then what this is going to tell you, and I did 4 contracts on that. What this is going to tell you is, okay, I had $330 at risk. My max profit is 668 there. So, a little over 200% net ROI profit potential. Now, my target is going to be based on filling that gap, because I think if we fill that gap and hit 280 on this trade, the spread should be worth about $2, but I'll put in 190 just to be a little bit safer. And so then if you want to figure, okay, what's 190? Well, it's going to be like 120% ROI, something like that. 130 maybe.
Yeah, right.
There you go.
There. Yeah.
So we know that if we put a 190 target and we're going to get 128% ROI or something like that. So then if I just shift, bear with me here as I shift my screen one more time. Well, actually 2 more times for you. If you go into here, my order was already filled. A couple different ways you can do this. One of the easy ways, just go to fill orders. Right there is where it pops up. Right click.
You're not on stage. Hold on. I got it.
Sorry. Under filled orders right here. Okay. It should show up under activities and positions if you use Thinkorswim like I do. Just right click, create opposite order. That create opposite order is just an easy way to make sure you get the order right, because obviously Thinkorswim knows exactly what order you put in. And so they're going to be able to create that opposite order for you. And then under credit, because remember, we paid a debit to open. So we're going to use a credit to get out, pay a debit, get a credit back. And then, of course, you want to change this from day until good till canceled, because that good till canceled order is what's going to leave it sitting in the brokerage account, for the next 25 days. So if it hits the target, it's going to automatically get out, because that's going to be a working order that entire time. If it doesn't hit the target, then we're going to lose the trade. All right. So that is the IBM trade. $1.90 is your target. And I'll go ahead and post that in here for you as a one updated full alert. Target equals 190 GTC limit. All right. And then I just send that order off, and it's going to be a working order sitting in my brokerage account. Now, let me also go ahead and post it for the members inside our trade sheet. September 22nd. I cannot believe it is September 22nd. That is crazy. Summer's over, Dave.
Is it?
Yeah. Yeah.
I mean, if you live in Florida, you don't necessarily notice. So I have to ask.
I guess that's
Yeah.
true.
We did talk about people watching or reviewing the content in the members area, the $1 members area, and the training over the weekend. And we had 1 or 2 people say they did that. So I just want to say thanks, and I'm proud of you folks.
And we owe at least one person a sweatshirt. Do you have a list of people who respond? We have to do the honor system. So if you did, you have to DM Dave your email. Dave, can you show them how to DM you?
Yeah. So if you, I'll put a little graphic in the chat here, but basically, if you hover over any of my messages and you click that little double speech bubble icon, you can private message me.
Okay. It says start private message. Just click that and then DM Dave, and we'll pick a couple people to do a sweatshirt for who DM you. Got to use the honor system. We're just going to trust you if you say that you went through those 3 trainings. Just private message Dave there and say, hey, I went through, and here's my email. Okay. So we did our IBM trade.
Before you continue, for a couple people have asked about a replay of last night. We're actually going to do that in a few minutes at the end of this session.
Yes, we are. And I got to move quick because it's already 10:40 a.m. somehow. Okay. AZO, this is AutoZone. Phenomenal stock. Really nice kind of pause and turnaround potential here on AZO. Just a phenomenal stock. By the way, breakout signal here was also a beauty. You saw the zone here at the 3,900 that this thing broke through and has absolutely been ripping since. We'll probably get another zone forming right around 4,100 if you can hold that level. And so this is a great example of also where you can use a max profit. Yeah, Steve, the max profit is going to be $1.67, but that would make it worth $2.50. So we're doing $1.90, which is going to make our profit like, I forget what I paid, 83. We're going to make our profit $1.07. So we're going to make 107 on it by using that target. Okay. So AZO, really great stock. Yeah, we'll see how they do on earnings. Not typically one that has a massive implied move on earnings, but this would be a longer term play anyway. This would be like, similar, going out 25, going out 30 days and seeing if it can make all-time highs once again with that really nice kind of turning point last week. And this is another great example to use a debit spread because most people cannot afford to buy calls on AZO, right? Let me just look real quick. I won't even share my screen. I'll just look it up real quick here to see what that would look like if you wanted to trade out 25 days on AZO, something in the near at the money here. $130 call option, Dave. So you could buy one call for 13 grand if you want to do that. I don't typically recommend that, but to each their own. But you could buy the same level vertical spread for $20. So still, don't get me wrong, still expensive. We're talking about a $4,000 stock, but yeah, a lot less. And sometimes they do shrink it down to $10 spreads there. But let's see if you wanted to go to the Novembers, you can even trade it for about $4. So you could trade it for 13 grand or $400. Up to you guys. So go to the Novembers if you want to get those $10 wides on AZO. Manny,
sorry,
go ahead.
Just real quick, couple people for those who missed the IBM trade that Nate did a couple minutes ago and posting that in the announcements. Just scroll down below the presentation.
Yeah, and you will not get IBM to fill at 54. The fill there is 83 cents. 83 cents is the fill. Don G, 83 cents there, debit. No official recommendation on AZO. I'm not going to give you one, especially right before earnings. Just one for the watch list, one that I like, that I think is worth keeping an eye on. And if you like it to go to all-time highs, trade those Novembers or later for that. All right. Now, my ironic lesson of the week is why most hedges don't work. Because if you guys remember, I was kind of saying, throwing out hedge here, hedge there. I thought there was a decent chance we would get a sell the news type of reaction from rates being exactly what everyone already priced in. Turns out we didn't. We got a little bit of back and forth, but really mostly a whole lot of nothing, and then ended up just grinding the week higher. And so, which of course, Dave, on the round table is exactly what I predicted, and then lit a whole bunch of hedges on fire. So, that's if you guys ever think that you're the only ones who look at a chart and say, "Oh, it did exactly what I thought it would do," and somehow I lost money. No, I was there. I was there last week. Thankfully, our mechanical strategies take that out of the equation. So, not to go on a whole diatribe here, but if you guys want to know one of the reasons I'm so mechanical in my trading, overnight options and automated options, and the way I do it, guys, it's partly because of that. Because when you start kind of manipulating what you think is going to happen and then making trades, a lot of times you can be right and still lose money because the mechanics are messed up. And if you're doing what I do, which is you're live to hundreds of people every day and you're trying to give examples of trades and all that, well, then sometimes you end up with a whole flurry of open trades that, that you're not really managing as accurately as you should. So just a word to the wise there. It's one of the benefits of being more mechanical in your trading. All right. With that said, let's talk about why most hedges don't work and why I certainly do not recommend using them in most cases. So it's a popular idea. It sounds good to have protection, but most traders really do not execute this well. So today I'm going to walk you quickly through the numbers when we talk about a basic hedge and just why I'm not a fan of this, why I don't think it actually makes sense over time. So here's the idea. Very simple idea here. If you take a profitable system and all you do is add a just in case hedge, well, what it's really going to net do over time is weaken the performance of the hedge. So take a strategy that has a 75% win rate, an average win of 80, and an average loss of 100. Over 100 trades, your regular expectancy would be really, really good, right? You'd have over a 1 profit factor. You'd have $3,500 in net profit over 100 trades. Really great. Now, if you wanted to add a $20 hedge that generates $50 when the market goes down to lower your loss, so when you're wrong and it goes down, what would you do? Well, over 100 trades, your new expectancy would be 4,500 on the wins, but you're losing 20 on each one because your hedge burns up. Your 25 losses, you lose 100, but you make that 50 because your hedge helps you out, and your net profit ends up being 3,250. So let's just go back here, 3,500 to 3,250. So that's a lot of extra work. And by the way, it requires perfect execution just to lose money. Okay,
And
just
doesn't
to
even
have a
count
net
fees.
loss. Say that again, Dave.
And doesn't even count fees for the extra.
Well, yeah,
extra
true.
work.
Doesn't even count. Great point, actually. Great point.
Yeah.
That doesn't count the fees in there. So obviously, that's just a very generalized example. But honestly, it's probably much worse if you actually take the average performance for what most people actually do on executing a hedge. So let me ask a question that hopefully you guys all know the answer to, but we'll just say it out loud. We'll just firm it up and say it out loud because sometimes that's what you want to do to make sure that you do it right. And by the way, the other thing, Dave, that doesn't take into account is that most people don't actually execute a mechanical hedge, right? They execute a hedge when they feel like it and when
It's
they're
an emotional
nervous.
hedge.
Yeah, and that typically the performance on that is much worse. So how do you know if a hedge is worthwhile? Well, hopefully everyone already knows the answer to this, but it's a very, very simple answer. If the strategy is profitable on its own, then it's a worthwhile hedge, meaning it has its own positive expectancy and isn't just there to make losing weeks feel better. Okay? So that's when you know a hedge is worthwhile, not when it makes you feel better because you had a bad week, but when it has its own positive expectancy. Most hedging strategies are not profitable on their own. Period. End of story. The vast majority I've seen, if you just run the numbers, are actually losing strategies. Guys, why would you add a losing strategy to a winning strategy? Just to make you feel better on ugly weeks? That doesn't make any sense. So while most traders might pat themselves on the back when the market drops and they make a few bucks, they are actually crushing their long-term compounding. Now, one way to hedge, while not just taking money out of your winning trades, is using the two-way trade. So Dave mentioned one. Maybe we'll do one in Tesla. Anyone want to do a Tesla two-way trade? Give me a yes in the chat. We'll do one. But first, let me just show you what a typical hedge might look like. It looks something like this. Now, again, I'm being generalized because none of you gave me a specific hedging strategy that you're using, but I just wanted to give you an example of one. This is one where you're looking for big drops in the market, right? Well, what happens? Well, you lose most of the time, right? I mean, obviously, that's what happens. Look at the market. We started by looking at the market on a weekly chart, and you guys saw what the stock market looks like over the last couple of years. You have some big winning weeks. That's great. But over time, you're just losing money. Now, you could do something that's a little bit better. You could do something like this, maybe. This has a slightly positive expectancy where you get a couple more bumps, positive bumps in the road, like this one, right? Still not great. I mean, it doesn't fill you with joy to see that chart, but most people honestly do something more like this. So, what I would recommend if you want to do something that is more kind of robust, do something like a two-way trade, right? It's still going to protect you if the market flushes, but you're not losing money if the market rallies. Okay, so that would be my kind of typical hedge recommendation. And we can talk about two-way more, in a more sophisticated way at some point down the road. But for now, let's just do one in practice on Tesla, and we can talk about what actually happens in these scenarios with Tesla. Okay, let me see here. Oh, by the way, that QQQ one that we did on Friday is almost there, almost filled. All right, let me share my charts here, and we'll get over to Tesla.
Hey, real quick, for the people that just want to take the training anyway, even though they missed kind of the weekend thing, the 3 classes. One was the debit spreads versus, well, it was basically debit spread training.
Yep.
What were the other 2? Do you remember?
So the other 2 were the wrap orders, which is Graham's lesson. It's in there, I think somewhere near the top, and then the automated exits using the targets. So those 3, I think, are probably the most paramount, especially if you want to understand the way that I trade, and hopefully, can make more sense of opening and closing playbook and that sort of stuff. Like, those are really the 3 that would make the biggest impact for you. All right, so this is Tesla, guys. The idea with Tesla is obviously, hey, it's overextended. And over the next couple of weeks, it's probably going to, keep ripping, keep squeezing, and get up near those all-time highs, or it might flush back down into a support area, 380, something like that. So instead of picking one or the other, if we just believe that it's going to move, we can do a two-way trade. Now, two-way trades are really nuanced and dynamic because you can do them from anything to a high risk reward, low probability, to actually a very high probability trade, or somewhere in the middle. The way that I'm going to look to trade Tesla is at least like a 40 to 50% ROI, right? Because I don't really want to trade Tesla to make 10%. There's a lot of, I think, better opportunities to make 10%, including just a more defensive trade on Tesla than a two-way. So I really want to make at least, 40, 50% on Tesla. And the way to determine that and to see if there's a worthwhile trade is to simply look at the options themselves. Can I put on a trade that requires it to move little enough that I feel high confidence and still pay enough that I want to take the trade? So what we do is we go to Tesla, TSLA, and we'll give this trade 11 days here to make the move, right? Because we don't want to trade way out. We want to trade over the next couple weeks. Does it make a rip higher or does it fall lower? If you look at the weekly chart, you can see Tesla's covering a lot of ground. It covered 329 to 350. So about $21 this week, 4 weeks ago. 353 to 395, so over $40 that week. Here it didn't actually cover much ground. We opened at 423 and closed at 427, but at the peak it was down about $20. And this morning already, Monday, we've already covered about $16. So Tesla covers a lot of ground on a week-to-week basis. And so what we then want to look at is, okay, can we put the trade on in a way that doesn't require, outsized moves, that just covers a very normal move in Tesla and still pays us enough? Well, I just showed you it typically will move $20. So let's just start there a little bit below 20 at the 460 level. Okay, this will be 457.50, 460 on the call side. That'd be about $19 to the upside from where Tesla is right. And on the downside, go to the 432.50 and see what we get there. In this case, we're right in that range. Okay, we're right about what's that? About a 30% ROI. So we're in the range now. In 2 weeks, I think our probability of Tesla getting up into this 460 range or down into the let's see, we're at about 420s is pretty good. Let me move this down because wait, hold on. Let me change this. I went too high on the strike side. Hold on. Give me this and this. There we go. That $19 move on either side. Let's see. Pretty good. I mean, that's almost a 50% ROI there, depending on what we get filled in. So for me, this is a justifiable trade. I think Tesla can pretty easily cover $19 in 2 weeks. If it does that, I can make about a 50% ROI with this particular box. That's about a $19 move there on either direction. 460 to the upside, 422.50 to the downside. Let me go ahead and put this one in the chat. And we are doing this for the October 3rd. So 2 full weeks of movement, basically, on the Tesla chart here. Buy to open the October 3rd for 57.50 TSLA call. Sell to open the October 3rd for 60 TSLA call. Then we're going to buy to open the 425.
While you're doing that,
put side.
Patrick, we don't normally specify how many contracts you buy. That's completely up to you. What your investment budget is and plan is as to how much you invest in a given trade. The only time we really ever indicate how many to buy is if it's an uneven number. If you have to do like 2 of one side to even out 1 of the other side, then we'll give you the ratio. But how much to invest in something is an individual choice on your end.
All right.
We actually legally can't even tell you how much to invest. That would be financial advising, and we don't do that.
True.
Okay. Don't know enough about you to even want to do that.
There it is. And let me pop up our trade sheet as well, just to get that one in there. Okay. So that's a box trade, a two-way trade, whatever you want to call it. It's going to be, oh, dang it. I typed it wrong again. The talking and typing is my frenemy. All right. 425. You should be able to see it on my screen. Hopefully that helps. So right around 163. Yeah, I fixed it. Right around 163 there for the debit. We'll see if we get filled here. I'll give you guys a second. Yeah, exactly. So I actually think Tesla will hit 480. But we want to give it, we're only giving it 2 weeks here. So we want to have a reasonable kind of pacing for how quickly we want it to move. So with two-way options, one of the things that you really want to take into account is that you don't want to trade a stock in a way that it has to make like a abnormal move. You want it to be able to trade in a way that it can make a very, very normal move and still hit the target. Okay. There. And then, like I said, 240 target, 10% next week, or this week for that matter. I'd rather just get out, and because if it settles back down in between our strikes.
I don't know if it was just me, but you froze up there for a minute. So you said 240 and then didn't get the rest.
All right. Sorry, let me start all over again. If you trade two-way options, you want to trade in a way where you're not asking it to make an outsized move, right? You want it to be able to make a very normal move and still hit your target. With a two-way trade, if you're saying like, hey, I'm trying to trade this and it needs to make a really unnatural historic move to hit it, well, then you might as well just trade it directionally. With two-way, you basically want to say, listen, as long as it makes a normal move relative to how it typically does, then we should be in good shape. So, Jude, the way you manage it is you put that target on the trade, and if it makes a big move, it should hit that target. Someone asked if I could write out the trade. Yeah, it's right above you. It's already written out, but I'll write it out here as well. And then, guys, if you want, if you're a VIP member, then you get this trade sheet. Let me show you the trade sheet because I guess not everyone even realizes that we have that in the members area. But one of the things that you'll get in the members area, if you pay the big bucks, the $1 lifetime subscription, is you'll just get the trade document that lists it all. So even if you miss it during the chat or whatever, even if you want to go back later and just make sure you got the exact right trade, all the trades are in there for you.
Yeah, that's the $1. Just to be clear, because you said VIP, that could be anything. The $1 Playbook membership. If you didn't join the Playbook membership area where we have that, I'll drop the link in a second. For those of you who are putting in here, you're not sure how to direct message me, I'm going to direct message you. And then you should see at the top of the chat area, there should be a little red dot on the icon that has like 2 little speech bubbles on top of each other. You see a little red dot at the top, and you can answer my direct message.
Yeah. Perfect. Okay.
I'm assuming it's you and not me, but your internet is just real bad today. You keep cutting out, and you're frozen for me right now.
Sorry, for some reason, my internet seems to do this right around 10 a.m. It's like its favorite time to be buggy. But the last thing on our agenda is to check out the Insider class that Graham and Silas did. Really, I mean, the whole reason that I brought Silas on is because I think he has a level of software and technology that is actionable and unique to anything I've ever seen, which is saying something because I've been around the block now for a while. Don't be fooled by my glowing youthly looks. I've been dealing with traders and investors in our world for over a decade. I've had the sincere pleasure of really talking to some of the best in the world, and I think Silas is incredibly unique in what he's built. So we don't give away, quote unquote, give away our opening playbook sessions lightly. We do it when we think something's really impactful and meaningful and worth you guys watching. And so again, I could be talking about my own stuff and what I do today, which I'm very proud of all of that kind of stuff. But I'm purposely giving away the session so that you guys can see what Silas has put together, because I do think it's worthwhile and meaningful. So you don't have to go anywhere. You can stay right here. Dave's going to play that